Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index and the euro currency, as well as the gold and silver markets for Wednesday, April 20th. Starting off here with an intraday 4-hourly chart of the US dollar index, you can see the past day and a half's sharp, impulsive relapse below the 74.61 low from late last week. That reaffirms the broader relapse from last November's 81.45 high. The most important byproduct of this reaffirmation of the much broader bear trend that has negated that bullish divergence in short-term momentum above 75.21 we discussed in Monday's update. Is the definition of the 75.81 high from Monday now as perhaps this market's most important technical level. For until or unless the market can recover above that key bear market corrective high and risk parameter, an absolute fact, the broader bear trend, simple downtrend pattern of lower lows and lower highs remains absolutely intact, and further and possibly accelerated losses should not surprise. Here, looking at a daily log scale chart, you can see the magnitude of this broader slide that has in a quite orderly manner over the past number of weeks has stair-stepped its way down, with this latest stair-step coming from a 75.81 high, the recovery above which is required to arrest this clear and present bear trend and confirm the bullish divergence and momentum of a scale sufficient to expose a large degree reversal higher. Moving here to a weekly log scale chart, you can see the market's continued approach to the key 74.17 low from November of 2009. The extent of the past year's sell-off attempt has understandably driven bullish sentiment down to historically low levels, typical of major base and reversal environments. But until the market can confirm a bullish divergence in momentum of a scale sufficient to threaten this broader bear trend, and that level being now 75.81, market sentiment is not an applicable technical tool important in the reversal of such a clear trend. And if the market can be successful in breaking that November 9th low, you can see there's virtually no levels of any technical merit between that 74.17 low and the major low from March of 2008 down at 70.70. These issues considered, a resumption of this broader bear trend requires a continuation of a bearish policy for longer-term traders, with strength above 75.81 required to mitigate that position. And indeed, even shorter-term traders that have been now whipsawed out of bearish exposure as a result of that bullish divergence in short-term momentum above 75.21, they are advised to reestablish a bearish policy, with former support from the 74.61 area now considered as a new resistant area, ahead of further and possibly accelerated losses in the days and perhaps even weeks ahead. Similarly, but inversely, looking at the euro currency, you can see overnight's recovery above last week's 145.23 high. That reaffirms the secular bull trend and defines the April 18th high at April 18th low at 141.56 as perhaps this market's most important technical level, the break below which is required to confirm a bearish divergence in momentum on a daily scale sufficient to counter or threaten this major bull trend. In lieu of such weakness, further and possibly accelerated gains remain anticipated. You can see here on a weekly log scale chart virtually no levels of any technical pertinence whatsoever between spot and the November 2009 high at 151.47. That doesn't mean we're forecasting a move to that November 9th high, but it absolutely does mean that such upside potential cannot be discounted until or unless the market fails below a recent corrective low like 141.56. These issues considered, a bullish policy remains advised, with weakness below 141.56 required to warrant moving to a neutral sideline position. In lieu of such weakness, further and possibly accelerated gains are anticipated straight away. Now, given the inverse correlation between the US dollar index and the gold market in particular, it's not surprising to see continued proof of strength, very orderly but sound strength in the gold market, with overnight's strength above this week's earlier highs and resistance, reaffirming the broader bull trend, and defining Tuesday's 1488 spot 20 low as the latest and tightest corrective low and tightest risk parameter this market now can be required to fail below to stem even the short to intermediate term uptrend, let alone expose a larger degree correction or reversal lower. Shown here on the daily log scale chart, you can see the dominance of this year's continuation of the secular bull trend, shown here on the weekly log scale basis that has rendered extraordinarily high bullish sentiment readings basically useless in light of any confirmed bearish divergence in momentum. You can see the dominance of the long-term bull trend that should not surprise by its continuance or perhaps even acceleration. We're not much for forecasts using derived levels, but we have discussed in recent updates the prospect of this bull continuing to the 1630 area, which is the 1.618 progression of the initial first wave rally from October 08's 681 high to the the 681 low from October 08 to the $1,007 high from early 09, that first wave rally taken from the second wave low of 865. Its 1.618 progression relationship projects to 1630. From a short to intermediate term perspective, bullish positions advised last week from the 1473 area are advised to be maintained, with protective sell stops trailed to just below the 1489 corrective low from Monday at 1488. And in lieu of such weakness, we anticipate further and possibly accelerated gains. So a bullish policy remains advised with weakness below at least 1488 and preferably the 1445 corrective low from last week. And finally, looking at the silver contract on a daily log scale chart, you can see the continued dominance of this secular bull trend, with weakness below the 3970 low, corrective low from April 12th, required to expose a larger degree correction or reversal lower from an intermediate to longer term perspective. And given the dominance, but that's not atypical of such major bull trends, the current quote-unquote overbought condition in virtually every measure of momentum, be it the RSI or stochastics, simply does not matter at all. The only thing that matters is the market's ability to sustain recent gains above a recent corrective low. And even on a short-term perspective, you can see on this intraday chart the market's break yesterday above this week's earlier resistance around 43.38 that now is expected to provide new support ahead of continued gains. And also we believe it defines the 42.94 low from yesterday morning as the latest and absolute tightest risk parameter this market is now minimally required to fail below to even defer the secular bull trend, let alone threaten it. These issues considered, a bullish policy, a full and aggressive bullish policy in the silver market remains advised, with weakness below at least 42.94 and preferably 39.70 required to defer or threaten this bullish count. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.